Hi guys, this is Felix the Tutor, and today we're going to be tackling the mythical animal called bank reconciliation statement. So I made this video in parts so that at least we can cover, because just one video it was going to be far too long, and I don't want to be long videos because they're always very long and boring. So let's try to make this one quick. So basically you have the idea behind bank reconciliation. You have to also understand like the overall idea. What are they trying to achieve by making people do a bank reconciliation? We want a reconciliation between the business bank account, which is the ledger, and we want a reconciliation with the business actual bank account with the bank. So you have to now understand that there are two banks which are now in play. One in the ledger, then there's the other virtual one, which is the money deposited in the bank. So the treatment is also going to be key, understanding the treatment of the two accounts, so that you don't make mistakes. The one in the ledger is always an asset, right? And the law of assets, remember we talked about it, it increases on the debit side, it decreases on the credit side. So you have to be sure and definite that this increases on the debit side, this increases on the credit side. We are going to also talk about how the bank account comes into play later on, but right now let's try to just get the overview. The overview basically means we are trying to reconcile what happened, the transactions that happened in the business and the transaction that happened in our bank account, to make sure that both transactions tally, so that if both transactions tally, then we don't have any problems. We do not have any problems, because you have to also understand there are certain things like bank charges which they are on the bank statement but they are not in the books. There are certain things like probably the bank erroneously deducts money from your account. That error is going to be on the bank statement, it's not going to be on the books. So in a way of making sure that we merge these two things so that they say one thing, they decided to come up with this whole idea of bank reconciliation. So you have to understand, since this one is an asset, we have to also understand that when the bank looks at you and you have given them the money, the bank now has a liability. The bank now has an obligation to pay you that money that you have deposited in your bank account. So basically the bank, remember we are on foundational phase, so please don't go about trying to start another argument about stuff. If you have money in your bank and the bank is looking at your business and your business bank account has money, what that basically means is you are a liability to the bank. Okay, understand, you become a liability to the bank. Becoming a liability, this is supposed to help you read the bank statement easier. When the bank says credit balance, what did we say about liabilities on the previous video? We said our creditors increase on the credit side. So if money is now being put into the account, it now means the account is being credited. Your liability is increasing on the credit side. That's why they're saying your account is being credited. If money is coming back, coming out of the bank account, look at it from the sense of a liability. So the bank is looking at their liability with your business and saying money has now been debited, meaning you are now having less money than you had before. So they are going to be throwing funny jargon saying favorable balance. When they're saying favorable, you now know favorable, there is money. Favorable to who? Favorable to the business. Okay, there's a favorable balance, which means you have money, it's positive, which means it's a credit bank balance, right? Credit bank balance. When they're saying it's an unfavorable, meaning it's a debit bank balance. So they might come to you and throw these two terms, but please don't allow these two terms to confuse you. Please don't allow the two terms to confuse you. Remember, we said when the bank is looking at your business, it's as if it's looking at a liability. Okay, when the bank is looking at your business, it's as if it's looking at a liability. And when your business is looking at a bank, it's an asset. Okay, so how do liabilities operate? Which means the more you deposit, the higher the more you deposit, the higher the credit they have with you. The more you withdraw, the less, which means it's going to be on the debit side. So be able to differentiate and tell the truth. And yeah, that's about it. The overview, overall, that's what we'll be talking about. Matching the business bank account with the bank's bank account of the business. That's basically entirely it about bank reconciliation overall. Thank you so much.